welcome to another webinar with us here at Global Wonks. I'm delighted today to be joined by Indranil Ghosh, founder and CEO of Tiger Hill Capital. Before I bring in Indranil and introduce his background and his work, I'd like to welcome some of our new audience members, clients, experts, and general community members of the Global Wonks network, as well as welcome back some of our regular audience members. As you know, Global Wonks is a real-time expert network platform, and as well as providing our clients with a real-time Q&A tool, we'll now be also offering a automated call product as part of our suite of products. So if you would like to learn more, please get in touch with our sales and client success team at emily@globalwonks.com. So let's get started. Tiger Hill is a London-based firm investing in the transition to a global low-carbon economy. The firm partners with visionary leaders to build investment platforms and businesses with a societal impact mission. Their sustainable investment and business building areas include renewable energy, infrastructure and industrials, regenerative agriculture, diversity and inclusion, and the future of work. Throughout his career, Indranil has advised Fortune 500 companies, investors, and governments around the world before working in ESG, the topic of today's discussion. He spent many years at various hedge funds and consulting firms, including Abu Dhabi Sovereign Investments and Development Fund, Bridgewater Associates, and McKinsey Co. Before I bring Indranil in, I'd like to just mention a little bit about the topic of discussion today. Indranil will be speaking with a view to his most recent work, Powering Prosperity, A Citizen's Guide to Shaping the 21st Century. And he'll be explaining how we can solve some of the critical challenges of our time by pursuing three key imperatives: inclusive governance, investing with purpose, and empowering local communities. I think the events of the past year have brought to bear just how important these factors are, not just in how we live, but also how we think about business and investment questions. So as you go through the webinar today and hear Indranil speak, please make use of the Q&A tool in your Zoom screen, as always, and ask questions that will form part of the Q&A in the latter half of the session today. And with that, Indranil, take it away.
Thank you, Bilal, and a warm welcome to everybody attending this webinar. Now, I should warn everyone that I'm a scientist by training, so I like to begin any discussion with a hypothesis and then go in search of facts and figures. So if we take as our hypothesis of the day that ESG investing can make a significant contribution to long-term prosperity, what numbers can we find to support or refute this hypothesis? Well, if we start by taking the achievement of UN Sustainable Development Goals as a proxy for long-term prosperity, then according to the UN itself, we would need to invest somewhere in the order of $5 to $7 trillion per year into areas such as beating poverty, decarbonizing the economy, reducing inequality, or social justice. Now, of that 5 to 7 trillion, the UN reckons that about 3 trillion is unaccounted for by any government budget. So this is an investment gap, and it's mostly in emerging markets. But on top of that, the UN makes another very bold assumption, in my view, which is that most of the investments to pursue SDGs in developed markets can come from monies and investments that are currently deployed inefficiently or in unsustainable activities. So an example of that would be something like the assumption that the US can reduce some portion of the 18% of GDP it spends on healthcare to something closer to the OECD average of 9 to 10%, and redeploy some of that inefficient spending to sustainable causes. And that's potentially a very big assumption. So in my book, I actually estimate that the annual investment gap to achieve the SDGs globally is more like 5 trillion, not 3 trillion, because the UN underestimates the amount of social housing, childcare and elderly care that we need. And if the assumption that developed markets can't or can redeploy inefficient spending into SDG purposes is untrue, then the funding gap is even higher than 5 trillion. Now, just to give you a sense of magnitude, if we had to plug this 5 trillion gap from the public purse alone, that would require a 20% increase in global taxes across the board. because the global tax base is about 25 trillion today. Now, I think we all agree that that's not feasible. So we would need to get a lot of that investment from private capital. Now, the global pool of private wealth is currently somewhere in the order of 200 trillion. So it is possible to deploy a small proportion of that wealth to address sustainability issues. And so in theory, at least, sustainable investing could make a big difference if the capital is deployed wisely. So first question is, how much private capital is being deployed into sustainable investments today? Well, according to the Global Sustainable Investing Alliance, that figure is already upwards of $4 trillion per year. Now, that flow is not only large, but it seems to be quite resilient. In Q1 of 2020, when arguably the COVID was at its peak, $50 billion of flows went into ESG funds. Whereas if you look at the fund universe overall, almost 400 billion flowed out of overall funds universe. And if you're in any doubt that ESG investments make a market rate of return, there's a growing body of evidence that they do. And in fact, in many cases, they make an above market rate of return. So if the ESG flows are large, on the order of magnitude of what we need to address the UN SDGs, if they're resilient even in times of crisis, and if the returns on these investments are sound, well, the big question is, where's the impact? Well, I think there are a lot of reasons why the additive impact that we would like to have from ESG is not happening. Most importantly, I think 95% of ESG flows tend to happen through passive funds that invest in developed market large cap companies. Now, arguably, ESG investments probably be best deployed in smaller companies because large cap companies can get that capital somewhere else. And rather than putting it into big companies, maybe ESG investment should flow more to smaller, disruptive, innovative companies that are doing something much more direct about sustainability issues. Or maybe some of that ESG investment should just go into good small, medium-sized enterprises because they support such a large proportion of the economy in terms of middle and low-income workers, and this would provide additional resilience. A second problem, of course, is that the investments are flowing mostly into developed markets where arguably the need is much bigger in emerging markets. But perhaps the biggest challenge is that these funds are passive. And so they do very little to engage even the large companies they invest in to promote more sustainable business practices. Now, on top of all of this, of course, there are no standards right now for how corporates should measure and report impact. And in fact, research by Professor Roberto Rigobon of MIT shows that in an analysis of 5 different ESG ratings agencies, there was only a 15% correlation between what the agencies deemed to be the top performing ESG companies. So if we can't even agree on what a good performing ESG company is, there's obviously a lot of room for greenwashing, whereby companies can mask big problems they have in sustainability by checking the boxes on a lot of less important issues. Because right now, anyway, we tend to judge companies' ESG performance on an aggregate score. So a lot left to be done, but can even this checkbox-based approach to ESG investing be somewhat improved? Well, I think there the news is perhaps encouraging. There are developments underway, which I think could make a good positive difference, particularly in Europe. First, on the issue of reporting standards, it's likely that by 2022, the European Commission will issue non-financial reporting regulations for banks and insurers based on the recommendations of the Task Force on Climate-Related Financial Disclosures, or TCFD. Now, under these regulations, banks and insurers will have to report on how they expect climate change to affect the financial performance of the financial performance based on their annual filings. So at least this addresses some of the E issues in ESG. And there are other standards bodies that are being adopted, like SASB, gradually, which could help here. But I think there are other things afoot which can have an impact. So, for example, the European Central Bank has indicated that in its 2022 round of banking stress tests, it will integrate climate risk into what it considers to be negative economic scenarios. And what this means is that some of the worst for example, greenhouse gas emitting companies will show up as risky holdings and will probably drive a higher cost of capital to those companies unless they do something to mitigate their carbon emissions. A third factor that's underway, I think, is the amendment of some MiFID II rules by which the EU will make it mandatory within a couple of years for asset managers and pension funds and insurance companies to determine what their clients' ESG preferences are and to recommend products and services which are suitably aligned. And fourth, in order to assure people that they are investing in things that are credible from an ESG perspective, or ESG credible products, the EU is putting in place in a couple of years a taxonomy regulation which will specify what investments can indeed be classified as sustainable. So I think there are positive initiatives underway, and if they're adopted in Europe and beyond, we can see some more impact than we have done so far from ESG and sustainable investing. But I think the question is, will this be enough to really assure long-term prosperity? And here's where I'm much more doubtful. But to understand why, I think we need to dive a bit deeper into what do we mean by long-term prosperity? And how do we go about driving the kind of system change we need to achieve it? And Bilal, if we could pull up the first slide here, what I'd like to show you is how I think about prosperity. And if you write a book called Powering Prosperity, you have to give this topic of defining prosperity a little bit of thought. So when I thought about it and tried to think about what it is that people want, what do they care about? And throughout history, what have they fought for? It tends to be these three things. They want, I think, equal access to opportunity. They want their children to have a better life than they did. They want them to be better off. And they want a good place to live. Now, in other words, you could say that what they want is inclusion, sustainability, and a strong local community. But in order to achieve these things, you need a lot more than just ESG investing. For inclusion, I think, regardless of where you are in society, what strata you come from, you need equal access to political participation, to civil liberties, and to socioeconomic mobility. For sustainability, you need access to the basics in life: housing, education, healthcare, childcare. You need to have a clean environment. You need to have access to lifelong learning so you can move up the professional ladder in whatever work you do according to your skills and merit. And for a strong local community, you need local empowerment, decision-making power over how public finances and resources are used, what the area invests in. You need to create more of a creative hub in the modern economy where there's a seats of learning and research and innovation and entrepreneurship. And you need global connectivity to get access to the world's skills, talent, IP, and capital. But in order to actually get all of these things on the right-hand side, what you probably need is actually system change. And if you move to the next slide, Bilal, what I believe is that in order to drive system change, you need a lot more than just technology and innovation. Things like digitization or autonomous vehicles or vegetable-based proteins can help to solve some of our sustainability challenges. But by themselves, they won't drive adoption or traction. You need also changes in mindsets and attitudes. Your people, just because they have access to remote working and remote learning, won't use them, won't adopt them, as we saw pre-COVID. And the reason is because unless there are policies and institutions and just everyday practices that make this much less risky to do by yourself, why would people make the change? And so let me give you an example, that I think maybe illustrates this issue. I was giving a talk actually about my book to a professional services firm recently. And the topic was how the post-COVID acceleration of digital adoption could have many silver linings. And the conversation quickly zoomed in on higher education. Would the flexibility of digitally assisted learning finally end the tyranny of four-year degrees and even master's qualifications? I mean, after all, this very long educational process we have leaves young people with a mountain of debt It delays their entry into the workforce and cuts off many years of earning potentially. It delays important life events like buying a home or starting a family, and leads to a lot of societal issues. For example, slower and lower build-up of personal wealth, falling national birth rates, and not to mention stress and mental health issues. So on top of all of that, there's also no guarantee that the education will actually lead to a well-paid job at the end. So does the digital learning capabilities that we now have today open the door finally for job-relevant, bite-sized education that you can take throughout your life and update your skills while you get most of your practical learning on the job? Do you really need this sort of very bloated 4-year education system? Well, there's a lot of excitement in the group about this discussion until I asked the question, how many people in that group would be willing and comfortable to advise their children to skip university and pursue a work-study career path? And suddenly the table-thumping enthusiasm turned to deadly silence. System change was probably not going to happen in that room. And it was because people weren't ready to change their attitudes. And the reason was, of course, the institution and policies aren't there to support it yet. It's too risky to be the first one to take the plunge. For example, how many employers are there right now offering paid internships and work-study career paths? How many schools offer work-study programs and paid internships and charge their fees when they've delivered their end product, which is the students getting a job? And how many countries have actually replaced their, or at least supplemented their pension plans with something like a life account, where an individual, the government, and employers can contribute to a fund that an individual can then draw upon every few years when they need to reskill themselves, potentially move for work, and change careers? Well, a lot of things would need to change in order for higher education to move to a more practical model. Now, could ESG ratings and ESG investment help with this? Probably. There could be metrics, for example, on the number of high-paid or well-paid internships that a company offers that might drive more capital to the high-performing companies and create a momentum for change. But then again, that metric might get lost among the hundreds of other ESG metrics and not necessarily have an impact on this specific issue. So we need, in order to drive impact, a lot more than technological solutions. We need a change of attitudes, and COVID, I think, is helping with some of these attitude changes. But we also need changes in policies and institutions. And I could go on issue after issue and apply the same argument. It could be about affordable housing. It could be about closing the racial inequality gap. It could be about climate catastrophe and how to avert it. In each case, I think we need things like sustainable investing, which have an important role to play. We need to increase the rigor by which we do ESG investing. But we need a lot more than that. And we probably need to think about ESG in a broader context. It's certainly about environmental, social, and governance issues, but maybe we need a different acronym for what ESG is. Maybe it's more about engaged societal guardianship. And what that means is governments, corporations, investors, and citizens taking joint responsibility for how to improve the system. And that's what I talk about at length in my book. And at this point, I'll shut up and take questions.